Welcome to this beginner's trading course. During this course I will be explaining to you everything you need to know in order to get a very strong foundation that you can build upon during your trading journey. If you have already been trading for quite some time, don't worry, during this course I will also be sharing a lot of different gems which will be valuable insights to you. Welcome to this training. What you will learn in this training is the following. First of all, we're going to be speaking about the foundation of the financial markets. Secondly, we're going to be speaking about price patterns and indicators. Thirdly, we're going to be speaking about smart money concepts. Fourthly, we're going to be speaking about algorithmic signatures. After that, we're going to be discussing how to use TradingView efficiently. Then I will share with you how to create a trading model. A trading model is crucial because without a trading model, you're nowhere. And next step, I will be sharing with you how to log your data inside of the juicy Notion template, which you are able to copy paste and begin using for yourself to actually fast track your learning journey. And to end today's training, I will be sharing with you a free bonus. Welcome to this training. A question which I would like you to ask yourself is the following. What are the financial markets? I understand that many of you probably got into the world of trading by people sharing their fancy lifestyle, sharing their fast cars, you name it. And therefore you got into trading without actually understanding what financial markets are. Therefore ask this question to yourself. Financial markets are the markets that determine the pricing of everything. And when I say everything, I literally mean everything. What I want you to understand is that there are actually two worlds that we live in. On one hand, we have the regular world, where there are a lot of people that are working their jobs, that are living their regular lives, that are paying their rent, that are paying their groceries, you name it. And on the other world, we have the financial world. And in the financial world, there are actually way less people than within the regular world. But the financial world is actually the world that controls and determines the pricing of everything within the regular world. Therefore, I always developed a great interest in understanding the financial world because it has such a massive influence on the normal day-to-day life. And many people within the regular world are not even aware of what the financial world is and how it actually influences their lives on a daily basis. And there's a big reason for that, because they don't want people to understand. And I know that lectures like these are the types of lectures that these bigger entities don't want out there, but I've still decided to hop in front of a camera and actually share what I know with you, because I believe that this is the best way for me to help you to actually begin changing your life and the lives of your loved ones. So market participants speculate on future prices in the hopes of making money. That means that within these financial markets there are a lot of different market participants that are trying to speculate on future prices to actually make money. Fluctuations on financial markets are, however, not random. It's a rigged game. So what that means is that the opinions of all these different market participants actually has nothing to do with how the market is going to be priced in the future. That right there is the core foundational concept which I want you to adopt. And if you do not believe what I'm sharing, I understand, but trust me, if you watch this lecture with purely that perspective, I promise that by the end of today's training, you'll be looking at the markets from exactly the perspective which I've just mentioned to you. Because there's absolutely no way that these markets are random and that they're driven by supply and demand. So a question which you might be asking yourself now is, how do you actually make money with trading? When it comes to this question, I want you to understand that by means of speculation, you're able to profit from market fluctuations if you're right. This means that if you are able to predict the future price and you trade in sync with that, then you're actually able to make a profit from that market move. If you are expecting the future market price to be higher than the current market price, you go long. It means that you're buying the market. If you are expecting the future market price to be lower than the current market price, you go short. A good summary of what we actually do as traders on a day-by-day basis is the following. We draw lines and predict the future. And when we're right, we make money. A lot of money. And when we're wrong, we lose a bit of money. And it's okay. And the reason why is because if we're right, we always make more money than we're risking on average for each individual trade, but that's something for later during this training. We draw lines and predict the future, and that is my motto, and that's the motto which I want you to adapt as well. So you're probably asking yourself now, okay, what is price fluctuation? Well, price fluctuation is quite literally the following. In front of you, you can see a price graph which shows the pricing of the Nasdaq right here. What I would like to see is that throughout this price graph, what you can see is that the market expanded from this price level towards the upside. And what that means is that between this price and the price above, what you can see is that there's a difference in terms of points. And what that difference is this higher price, 20,259 minus 20,142. When you then calculate what the size is of that price move, that right there is what we call a price fluctuation. The same applies to when we try to measure the difference between this price and this price right here, the low formation. What I would like you to understand is that when you pay attention to this difference, you again see how big the price swing was. Now this is very simplistically explained what price fluctuations are. But what's important to understand is that these price fluctuations are not random. They're actually mapped out in advance, they're planned out. And that is something which I will touch on later throughout this training more, but it's important to note that what gets taught in economic classes with regards to financial markets is that all financial markets are random. All financial markets are driven by supply and demand. That's the general theory that the masters subscribe to. I want you to think about why are those things being taught in school? You need to understand that there's actually an entity that's in control of that what gets shared in schools, yes? What gets put in economic books and whatnot. Once you start to understand this and you start to understand that they're literally in control of what information gets spread and what information does not get spread, you must realize there's a reason why the masses are led to believe that all financial markets are random. There's a reason why the masses are led to believe that supply and demand is in control of every single price fluctuation. Why? Because on the other hand, smart money is just doing their thing. So what is the reality of trading? Trading is the true vehicle to freedom. And what it means is that trading is the only business model out there where you are not dependent on anyone. There's no boss, there are no customers, or there are no suppliers that you need to rely on. It's simply you and the market. Trading is both, however, the easiest as hardest way to make money. And I know that right there might sound complicated, but let me explain. It's the easiest form of making money because all that we need to do in order to make money is press a few clicks on our mouse. But it's the hardest way at the same time to make money because we need to know when we can actually press that button on the mouse and how we can actually handle ourselves. So what that means is that trading is not only a game of understanding the markets, it's also about understanding yourself. And that is something which a lot of traders neglect. They simply are in constant chase of that new price pattern, of that new trading strategy. But every single trader that has reached the stage of being consistently profitable has realized one thing, and that is that they must actually look within to achieve that consistency. Because the consistency that you're right now desiring has nothing to do with a particular trading approach or trading strategy. Surely, I believe that there are trading strategies which are way superior than others. There's a reason why I trade the way I do based on time and price. And I don't trade based on any indicator or whatever price pattern because they simply don't work. But let's leave that out of the conversation. What I want you to understand is that at the end of the day, you must be able to know yourself. You must master yourself if you want to succeed in this business. And that right there takes a lot of self-work, and that is something that I want you to prepare for as well if you decide to embark on this journey. Because you must realize that this is not something of, oh, you watch this course and all of a sudden you're able to go out there next week and begin trading like a madman. Now, and some of you are going to feel like that by the end of this course because I'm going to share a lot. However, you need to realize that you need to set realistic expectations for yourself. Give yourself time, and if you give yourself enough time, you will notice that everything will actually happen quicker than the timeline which you had created for yourself if you are willing to put in the work. That right there is the most important factor, that you are not only submitting to time, but that you're also submitting to the effort that it takes. Time and price, but the price is in the effort. So let us speak about price patterns and indicators. I've mentioned multiple times already throughout this training that I am not a subscriber of any price pattern or of any indicator. And the reason being is because I do not believe in price patterns and indicators being the core reason why the market moves up and down or sideways, you name it. I understand that sometimes that price pattern or indicator might actually show to you a good signal. It might show to you, okay, now it's time to go market long, and you go market long and you win, or the opposing, of course, if you're going market short. But at the end of the day, there's nothing inside of the indicator itself that's actually the reason why the market is moving up and down. So when it comes to candlesticks, what I want you to understand is that there are two candlesticks. There's either an up-close candle or there's a down-close candle. What an up-close candle looks like is the following. In order for an up-close candle to take place, what that means is that we must see an open taking place of the particular candle, and the candle can be whatever window of time. So between the open of the candle and the close of the candle, time is sprinting, and the time frame which you select to look at the markets from is subjective, meaning it's up to your choosing. But when it comes to an up-close candle, what sets it up is that we open up for a particular window of time, we drop lower at first, forming a low of that up-close candle, and we then see the market expand towards the upside and a high formation takes place. After this high formation takes place, we then see the market retrace and the close of the up-close candle takes place. Because the close right here was higher than the open, means that we have an up-close candle. When we pay attention to a bearish candle then, what we can see is that we open up, run higher at first, creating the upper part of this wick. We then see the market expand towards the downside and we form the low of that candle. And when that low formation takes place, where we form a lower wick, what we see taking place is that a retracement higher occurs and the close of that candle takes place. This right here is open, high, low, close. And for the bullish candle, it is open, low, high, close. Once you start to pay attention to this, trust me, you're going to realize later down the line how truly important this logic right here is. Because it's actually in the open low or in the open high that smart money is showing its hand to you. Again, candlesticks are subjective in the form of what time frame you look at, and the reason being is because you might be looking at the charts right now from the hourly time frame. I know that someone else might be looking at the charts from a 30-minute time frame, or even a 45-minute time frame, or a 4-hour time frame, you name it. At the end of the day, you must understand that all that matters is literally the exact time on the x-axis and the exact price on the y-axis. And once you start to see through the candlesticks and you start to realize that you can actually trade without candlesticks, a whole new world will open up for you. But if you're right now a complete beginner and this is the first lecture that you're watching of my public YouTube channel, get it out of your head because you won't be able to trade without candlesticks anytime soon. If you, however, have been studying my content for quite some time and you've been studying time and price cycles for quite some time, you must realize some things already. And once you start to see those things again and again and again, you'll smile. And that's something which I want you to investigate as well if you're at that level. So let us speak about supply and demand, which is a very common trading belief within the trading industry, where everyone that has been trading for quite some time must have encountered the term supply and demand. Even if you're not a trader and you've simply paid attention to economic classes, you must have heard the term supply and demand. And how supply and demand is understood by the masses is that supply and demand is the reason why the markets go up and down. Basically, if there's more supply than there's demand, the markets are going to go lower. The price will go lower. If there, however, is more demand than supply, what that means is that the price will go higher. That right there is how the masses are introduced to price fluctuations. And I'm not saying that within physical goods that's not the case. However, when we're speaking about futures, a completely different state of mind and belief has to be adopted. And once you start to understand that supply and demand is the biggest fallacy ever created, you begin to realize, damn, it's actually a rigged game. You tell me, if supply and demand is the reason why price is moving up and down all the time, how is it possible that I literally have specific price levels that I know will get reached at specific times, and when those levels get reached at specific times, I am able to anticipate rejections of those levels to occur? You tell me how supply and demand has anything to do with the logic of time and price. Once you realize that supply and demand has nothing to do with the logic of time and price, and that time and price are the true reference points for the algorithms that deliver price, which we'll get into in a bit, don't worry, you begin to look at the markets from a completely different perspective. And you begin to understand the reason why you've never been able to find that stage of consistency which you have been looking for, or that success which you so deeply desire, is because you have been looking at the markets from a blurred perspective, from a blurred lens. You need to start looking at them from the perspective that everything is already mapped out. And once you start to look at the markets from the perspective that everything is already mapped out, it's already written, which is funny because I actually have a tattoo on my left arm which says it is written, because not just the markets are written, everything is written, but that's a topic for a whole nother time, not for this course. But what's important to note is that because I have that belief that everything is already mapped out, everything is already planned out, all that I need to do is I need to recognize the plan by smart money. And when I recognize that plan, I'm able to find opportunities in sync with that plan. But if you come to the charts with the idea of, oh, supply and demand is the reason why price is going up and down, or this indicator is giving you a buy or sell signal, you tell me, how are you able to have confidence in your trading approach? There's no way that I believe that you can have confidence in your trading approach if it has nothing to do with time and price, because you are putting an extra layer between you and the market. Once you start to truly just pay attention to time and price, which is the market, you will begin to see the same repeating signatures which you will learn during this course today, and you will be like, damn. Yes, it was indeed hidden in plain sight all this time. And I'm helping you out now to not only adapt the right mindset which is required to begin seeing these things, because that's what I'm doing with you now. I'm literally making sure that you're able to understand what I'm about to share with you. You need to have a certain mindset in order to begin grasping it. And if you have made it so far into this course and you're still watching, it means that you have what it takes. All that you need to do now is you need to submit to time and investigate the things which I'm about to share with you. Because if you investigate them in your own charts, man, oh man, oh man. And the fun thing is, I don't want you to believe anything I say. I want you to see it for yourself. I want you to try and find and prove me wrong. Try and go into the charts and say that there's no algorithm. Because once you start to see these things, there's no way that you can believe that there's no algorithm, honestly. Supply and demand is a trap to manipulate the masses. That right there is all I want to share with regards to supply and demand. Price patterns such as head and shoulders, flag patterns, reversal ascending patterns, or double tops or double bottoms all have nothing to do with why the market is moving the way that it's moving. And the reason why these price patterns still appear from time to time is due to the fact that they actually get engineered by smart money. Why? Because they need to engineer liquidity which can function as the counterparty to fulfill their orders. And the way that they do that is by causing these price patterns to form within the charts. And when they cause these price patterns to form within the charts, a lot of retail-minded traders will look at that price pattern and will simply engage based upon it. Whilst in reality, there isn't anything to engage upon yet until manipulation takes place. Next, that indicators play a huge role when it comes to a lot of people their analysis, such as momentum indicators, volume indicators, or even chart patterns which can function as indicators. You need to understand that none of these methods have anything to do with the core reason why the market is moving the way it's moving. So in my opinion, to pay attention to these types of things is foolishness. Why? Because you're putting an extra layer between pure price action. Meaning, you're putting an extra layer between you and the market, which is only making it harder and harder for you to see exactly what's going on. If price patterns or indicators were the reason price fluctuates, how would the market know what to use for that particular day? How would the market know that for that particular day it's going to be using a head and shoulder price pattern, or it's going to be using, for example, a double top, or it's going to be using a moving average rejection, or a MACD cross, or whatever else you could use to basically trade, which is not time and price? How would the market know each day what to actually use? That question right there should already be the trigger for you to realize that none of these things have anything to do with how the market is moving. All that matters is time on the x-axis and price on the y-axis. And I know that that right there might hurt some feelings, especially if you have been trading for quite some time already. But I'm sharing this with you out of love. I'm sharing this with you because I want to make an impact on your life. I'm not sharing this with you because I want to like show off or whatever. No, if I want to do that, I just post an execution video of me shorting the absolute high of day or buying the low of day. No, I'm here in front of you to try and make an impact on your life and the lives of your loved ones. Because I believe that that right there is the most fulfilling feeling in the whole world. When I read all of the countless emails or DMs that I receive on a daily basis in which people are thanking me for the content which I've released publicly for free, it's just amazing and it fills my heart. And therefore I want you to just understand, I'm not your enemy, I'm your friend. And therefore think about the things which I'm sharing with you. And the longer you try to resist these concepts and these ideas, the longer that you're holding yourself back. And I know that might sound hard, I know that might sound complicated, but trust me, I held myself back for years until I begin seeing the light, until I begin seeing how rigged this world actually is. And it's confronting, it's hard to realize that, it's hard to accept, because it's not fair. But let me tell you something, life is not fair. And you either play by the rules of the game or you get left behind. It's either you getting eaten or you eat. It's that simple. And that is a mentality which is not for the majority of people. And that's also why the majority of people will never succeed in trading. However, if you are able to adapt that mentality where it's you hunting or you being hunted, poof. Watch how quickly the growth will take place, because you have what it takes. Like, I don't think you even realize how far ahead you are relative to the majority of people by the fact that you're still watching this lecture. Like, I'm not too sure how long we're already in, but I know that the majority of people do not have the patience to listen through these rants. They do not have the patience to simply just sit down for a moment and listen to a lecture. They have no patience to just observe, yes? All that they want to do is quick dopamine hits, and that's why you see these people that are going out there and saying, look, this 10-minute trading video will tell you everything you need to know in order to become profitable, or this indicator will save you all of the time you need, and all you need to do is press buy when it tells you to buy, or whatever. Look, the reason why these people that are selling those types of things are getting so much views has nothing to do with the fact that they're providing quality. No, the only reason why they're getting these types of traction is simply because they're making people believe that trading is easy and that they can get there quick. Well, let me tell you something, this is the hardest business in the world, but it's also the only business in the world that's worth pursuing, because if you go all in on trading just for the upcoming year, you don't even realize how much freedom you're able to achieve 1 year from now. And if you don't believe that yet, if you don't see that for yourself yet, work on getting that vision for yourself, because what's in your head will turn into reality. You need to have this vision of yourself of what you want to achieve 1 year from now. And right now you're literally at the beginning stages of the most wonderful journey ever. Even if you have been trading for quite some time already, even if you have already been studying all these different things and you realize that none of them work, the fact that you have met me is going to be the change within your whole trading journey. And that is not me speaking to you from a sense of arrogance or from ego. No, it's full out confidence. Because I know what I know, and I'm showing it to you every single week, and I'm sharing my analysis every single week, and it's boom, tick, 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 tick. And I'm right here making an impact for you, and I hope that you will put in the work. Because I wish that more of you would do. And I know that when I look at this lecture, the majority of people will have already clicked off, they will have already done whatever, they didn't have the patience to make it this far, and that's okay. And the reason why is because they don't have what it takes. It's that simple. So it's important to understand that the market doesn't refer to any of those price patterns or indicators to determine what will happen next. It's already planned out in time and price. And therefore you need to understand how time and price cycles play a crucial role in how the market actually moves. So what does actually work in the markets if everything else does not? What's the true reason prices are moving up and down, and more importantly, when that is occurring? That's the question you're probably asking yourself now, and I've already hinted at it throughout my rant, but hey, it is what it is. Smart money concepts, using time and price cycles. Once you start to look at the markets from the perspective of SMC, smart money concepts, you'll begin to look for things that the normal eye simply doesn't see. The regular retail trader will never be able to understand the way that we look at the markets, because we are literally doing the opposing of them. When the masses want to buy, we look to sell. When the masses look to sell, we look to buy. So we're always doing the inverse of the masses, because that is what smart money is doing. And once you begin to understand and begin adapting that trading methodology, you begin looking at the markets from a completely different perspective. Now, what's important to note before I move on is that nowadays there are a lot of traders that say that they trade based upon the smart money concepts or SMC. And when you watch their lectures, the first thing you see is them plotting out some supply and demand zone or whatever. Guys, I'm just going to tell you up straight right here, 99.99% of all the traders that you see online have absolutely no clue what's actually going on behind these markets. They have absolutely no clue how time plays a crucial role in moving price. They have absolutely no clue what price levels to refer to. The moment they plot a specific price range based upon whatever candle they might use, and they say this right here is the real supply zone or the real demand zone, and they show 20 to 30 R to 40 risk to reward trades, run. Because the only concepts that matter are time and price cycles. Because the time cycles tell you when the price cycles are going to behave in a specific way. That right there is, for the audience that has been with me for quite some time already, a major light bulb moment. And if you did not hear what I say, go back a few seconds and write that down. And the more you think about that, the more you try to visualize it, and the more you try to look at the chart and look for it. Jeez, that's what I just said I shouldn't have said publicly, and I'm going to keep it in the training. I'm going to make sure it doesn't get edited out, because I hope that in all of the rants I have lost the majority of viewers, because the majority of viewers do not deserve what I've just said. But that right there is the key to IBDA. You need to understand when the time is right for the price cycle to move in a specific way. And when you understand that the time is right, that is when you see price deliver in a specific way, not any time sooner. So when it comes to smart money versus dump money, what's important to note is that smart money is a collective of hedge funds, banks and wealthy families. Dump money, on the other hand, are retail traders and the masses in general, meaning retail investors, just people working their 9 to 5s that have some money on the side in the financial markets, just dump money in general, yes? You need to understand that it's this battle between smart money versus dump money. Once you start to behave like smart money does, you'll be able to see where dump money is actually making mistakes, and based upon those mistakes, we're actually profiting. Smart money is not simply just going out there and manually trading. Surely, sometimes they do. That's called manual intervention. Back in the day, they used to, however, back in the day, everything was done by hand, meaning this system of IBDA has been around for a very long time. I can go back to charts from centuries ago and I see exactly the same rejections of the same price levels at the same times taking place. You tell me that that right there is just randomly supply and demand being just the reason why price goes up and down. It can't be, yes? But what happened when markets were digitalized is that instead of them painting the charts themselves with their own hands, they started developing algorithms that could do it for them. And that is why nowadays everything is about speed. Once you start to realize that these high frequency trading algorithms literally took over all financial markets, and you begin to see that they're literally able to just move the markets the way that they want to, you begin to understand, hey, This doesn't just apply to the financial markets which are rigged. No, it goes way deeper than that, but I won't get into that because I know that if I would speak about those things, about world events, about developments, political, etc., then I know that my channel is going to be removed very quickly. Maybe I'll speak about it one day in a private environment or whatever, but just understand that your perspective should be widened. It isn't just about financial markets, it's about everything. Nothing is random. It's all planned out. And I know that that right there puts a lot of you off because you're like, no way, right? Once you start to understand that what I'm teaching to you throughout this course, and I know we haven't dived into the chart yet, that will come, don't worry. But once you start to understand the core behind that, what I'm explaining to you, and you start to understand that these financial markets are in fact rigged, and you start to basically draw lines and predict the future. The hook that I don't have that quote for just because it's a fun quote. No, I have that quote because it's the truth. So that quote, I draw lines and predict the future, is not just a quote which is fun to have. Now you need to understand that in order for me to call out that the markets are going to expand towards the downside aggressively in a very quick manner, it means that has to be paired with some turmoil within the world, meaning could be bad headlines within the news, or it could be announcements by presidents, or it could be wars taking place, you name it. You need to understand that within the charts it is already visible what's going to happen in the world. We don't know exactly what the event is going to be, but we can see that something is going to happen. Why? Due to insider information. You need to understand that these very wealthy individuals already know with a high degree of precision what policy changes or what announcements will be made and when they will be made. Therefore, they position themselves accordingly in advance of that. And I know that that right there is very controversial, me saying that, but at the end of the day, all that I'm trying to do is make an impact on your life as the viewer. And this is the message I'm trying to share with you. Look at everything from a completely different perspective. And once you start to look at the world from a completely different perspective, you will begin to become able to see these things again and again and again. And all of a sudden it will begin to click. All of a sudden it will begin to make sense why the markets are moving the way that they're moving. But this is the foundational belief which you must adapt if you want to make it in this world. So when it comes to these algorithms that are in control of every single market fluctuation, it's important to understand that time is everything. Time is literally for them the roadmap when to do specific actions within price delivery. Therefore, it's time then price. It's not price and time, no, it's time then price. Liquidity explained. Liquidity is the driving engine behind market movements. Smart money requires liquidity in order to fulfill their orders. Therefore, they engineer it. One of the ways that they engineer it is by causing those price patterns which we discussed prior throughout this training, where we discussed multiple price patterns that are very famous within the retail trading industry, and they actually engineer these price patterns so that liquidity will be engineered because retail will be acting based on those price patterns. And once you begin to understand that we are looking from the markets from the opposing perspective than the masses, all of a sudden every single price swing will begin to make sense to you. When the masses are bullish, we are bearish. And when the masses are bearish, we turn bullish. Algorithmic signatures. I will now be discussing multiple key algorithmic signatures with you, which you can look for right away after watching this course and go into your own charts to investigate. First of all, we're going to be paying attention to fair value gaps. On the left you can see a bearish fair value gap, and on the right you can see a bullish fair value gap. Fair value gaps are imbalances, and what these imbalances look like are the following. When we pay attention to the bearish fair value gap, what you can see is that there are 3 down close candles right here. Notice that when we pay attention to these 3 down close candles, you can see that between candle 3's high and candle 1's low, there's a gap. Meaning candle 3's high did not reach candle 1's low. Therefore, there was a lack of buy-side delivery throughout this price range right here. We can map up the full price range from candle 1's low to candle 3's high, and we can extend it to the right. Why? Because price will have to be retraced into that range so that buy side can get delivered to balance out the price range so that the market can expand lower. Now, I won't discuss balanced price ranges during this course because balanced price ranges are way too advanced as a beginner to look into, but if you want to dive into them later during your journey, you can find lectures on the topic on my public YouTube channel. When it comes to bullish fair value gaps then, what a bullish fair value gap is basically the inverse of the bearish fair value gap, where what you can see is that we have 3 candles right here. When we pay attention to candle 3's low and candle 1's high, what you can see is that there's a difference between these two prices. Therefore, what must happen is that a retracement has to occur into that range, the range of the bullish fair value gap. So the range of the bullish fair value gap is the high of candle 1 to the low of candle 3. Take that range, extend it to the right, and watch how the market will react of that. A retracement will occur because sell side has to be delivered into that range, and when that sell side delivery occurs, the market is then allowed to expand towards the upside. Price always has to be balanced out because balanced price ranges are to HYPTA, the interbank price delivery algorithm, the term for all of these corrective algorithms, basically how to actually deliver price. Time gets understood by time cycles, price gets understood by price cycles. When we then pay attention to breakers, what we can see is that on the left there's a bullish breaker and on the right a bearish breaker. The bullish breaker looks like the following, where we form a low, a retracement high occurs, and we then see a lower low forms. As this lower low is forming, the moment that we take out sell-side liquidity resting below this low right here, we see a displacement higher occur. When the market displaces above the final upclose candle before this manipulation leg lower, that there becomes your bullish breaker. That price range has to function as support on price in order for the underlying order flow to be bullish. We see a retracement taking place into that range, and we then see the market expand towards the upside. When we pay attention to the bearish breaker then, what I would like to see is that the market expanded towards the upside, forms this high, a retracement lower occurs, and we see this final downclose candle set one more push higher up. We see the market expand towards the upside, taking out buy side liquidity resting above this high, and as that high is being taken out, you need to understand that this displacement leg towards the downside below this final downclose candle is setting up a bearish breaker. So what you can see taking place is that as the market retraces into the price range of this bearish breaker, that range has to function as resistance on price in order for the underlying order flow to remain bearish. When the market then eventually retraces into that range, we can anticipate a new expansion leg lower to occur. And do you see how our fair value gap was created as the market took out this low, and how the market created a fair value gap as we took out this high? Fair value gaps form throughout displacement legs. Why? Because they show urgency, they show speed. Right here we can see the fair value gaps once again, and again keep them in mind. Don't forget about them. When it comes to mitigation blocks, it's very important to understand that mitigation blocks come very close to breakers in the way that they physically look, but the only difference is the fact that within a mitigation block there is no lower low which gets created inside of the bullish reversal, but instead there is a higher low. Within the bearish reversal, instead of there being a higher high, a bearish mitigation block actually has a lower high. So therefore it's very important to understand that from a visual perspective, breakers and mitigation blocks come very close to each other. And within every single key market reversal, there's either a breaker or there's a mitigation block. You can go into your charts and you will see that there's no reversal which takes place without any of those two. There's always a break or a mitigation block, so to not pay attention to them is foolishness. The next topic which we're going to be discussing is intermarket relationship. Intermarket relationship is the process of comparing highly correlated or inversely correlated markets to see whether or not we can recognize smart money's footprints in them. Let me explain. When we're paying attention to higher correlated markets, what that means is that we're comparing markets that should move in tandem with each other all the time. When one of these markets is not moving in tandem with the other markets, what that means is that manipulation is taking place. When we're paying attention to inversely correlated markets, these markets should always move inversely to each other. If one of those markets is not inversely doing exactly the same as the other market, what that means is that again manipulation is taking place. So when we pay attention to the charts, what I would like to see is on the left you can see the Nasdaq, on the right you can see ES. What's important to note is that when we pay attention to Nasdaq and ES, what you can clearly see is that Nasdaq created a higher low right here, whilst ES created a lower low. The reason why this is important is because both markets should always move in tandem with each other. They should always do the same. But because Nasdaq created a higher low whilst ES created a lower low, what that means is that manipulation occurred, and that manipulation is signaling to you that the time is right for a new reversal to unfold. When we pay attention to the timing element then of these swing lows, what I would like to see is that this swing low was the Asia low. Meaning ES took out the Asia low whilst Nasdaq didn't, and the reason why this is so important is because this is a session SMT. The only SMTs that hold any significance are SMTs which unfold relative to a previous time cycle, its high or low. If you do not understand time cycles yet, I highly suggest you to check out my topical lecture on the topic of time cycles, which you can find on my YouTube channel, because time cycles are a very crucial element to the way that I approach financial markets. I'm now going to be taking you with me into TradingView, which is the #1 charting platform. I'm not getting paid by TradingView to share on about the share view, but I've been using that platform for years now, and I would like to share some insights and some tips on how to actually use the platform as efficient as possible and how to make your experience with trading the cleanest as possible. So here we are on the TradingView screen, and what I would like to see is that we are on the daily chart of Nasdaq, but that doesn't matter. In front of you, you can see that I have candlesticks shown right here. I'm simply going to be walking you through each one of TradingView's individual parts, which I use actively. I'm not going to be speaking about things that I don't use, because why would I explain things that I don't use on a daily basis? So first of all, main thing what you want to do when you come to your TradingView for the first time is the following. What I want you to do is I want you to go and press on the chart, right click on the chart, go to settings right here, and when you go to settings, I want you to go to symbol. And the reason why I want you to go to symbol up here is because I want you to adjust the colors of the candlesticks right here. Now, this is something which was for me a big changer within my overall trading experience, where at first you are trading based upon very ugly candle cores, and therefore I want to share the candle cores which I use to actually trade on a day-by-day basis. In my opinion, these are the cleanest settings to use, so I'm just going to be walking you through my TradingView settings. I know that many people have asked for what my cores exactly are, so here you go within this trading. What you can see is that my body right here on the left is green. This is just the regular green. The second option right here for the body is full black on the top right. Notice that the opacity is 100%. For the borders, again, top right. And this applies to the wicks as well. And what it allows for is that it allows for this very clean TradingView chart, where I can see that the up close candles are green with a black border around it, and the down close candles are purely black with a black border around it. Now, the reason why it's important that your charts are clean is due to the following. If you do not have clean charts and your charts are super messy and you have a lot of things on them, in my opinion what that does is that it hurts your overall perspective on the charts. Therefore you need to make sure that every single time that you come to the charts, clean them up. Don't have too many lines on there neither. So when it comes to the next step then, what's very important to note is that we're going to be basically making sure that on a day-by-day basis we have the tools that we actually require close to us. So what it means is that you can see that there are a lot of different tools used within TradingView. However, it's important to note that we do not use like the majority of them. We only use a handful of them, and therefore what we can do is the following. What we can do is we can go right here to the list of tools, and here we're going to be able to press on this small arrow. When we press on this small arrow, what you can see is that the list of all the tools that are underneath that specific section appear. For me, I like to use the cross. So what I can do is I can press right here on the star, and when I press on the star, what happens is that it gets added to my favorites. And do you see what just appeared? What just appeared is the toolbar. And the reason why this toolbar is important to use is because on this toolbar you can have the tools which you can use all the time on a very easy way. If you have to go right here to the options all the time and select exactly the tool which you want to use, it's just a waste of time and a waste of energy, and after a few days that gets quite annoying. So therefore always use the toolbar. So when we move on to the trend line tools, then the tools which I use on an active base are the following. I use trend lines right here, and I don't draw trend lines to trade based on, don't worry. I simply use the trend line tool to draw specific lines. Next step what I use is I use the horizontal line and the horizontal ray. Next step what I use is the vertical line to pay attention to time. And that's about it for the lines. Then we move on to the Fibonacci tools. The Fibonacci tools which I use are the Fib retracement right here. That's important to me. And that's about it. I don't pay attention to GAN because GAN is bullshit. And I'm sorry to throw it out there. I know that I heard some GAN traders out there, but GAN has nothing to do with why the markets move the way that they do. When we pay attention to the patterns then, I don't use any of these patterns right here. I don't believe in them. I don't believe in them working. Elliott waves is also bullshit. Cycles right here also do not get used. Simply pay attention to time cycles manually or use an indicator which spots them for you. But using these tools in my opinion is all a distraction. Like sometimes I see people put these cyclic lines on the charts and they have like vertical lines all over the place, and I'm like, guys, you cannot even see the market anymore. Like, what are you doing? It's not like the more lines you put, the smarter you are. No, absolutely not. I believe the more lines you put on your screen, the more foolish you are. So even if you have all these different price levels annotated, what are you doing? You cannot even see the chart anymore. All I need is a blank chart, and I need to know where's the time cycle open and where's the close, where's the high and low of the time cycle, where are the key levels that I'm going to be trading off. That's it. That's how straightforward my process is. Now when we pay attention to the next tool then, we can be utilizing the projection tools. I utilize long position, short position. Next step I use price range right here to measure, and that's about it for this. Sometimes I like to use date range, but it's not something I use actively. When we then move on to the drawing tools, what I like to use is first of all the brush. I like to do this when I'm annotating specific things, or I like to use the arrow as well. I like to utilize rectangle, I like to utilize the path tool as well, and that's about it for this list. Now, the reason why it's important that you're paying attention to this, and I know that many people are probably not interested in this at all, and if that's the case, all good. But the reason why this is important to do is because what I'm showing to you is I'm showing you my workflow, I'm showing you my routine. And this is what's going on behind the scenes. Look, I normally only share my trades and such, but now I'm also sharing with you, okay, this is actually what's leading to those trades, what's the process behind them. And therefore I hope that you're finding this insightful as well. And for each one of these individual tools, what I'm doing is I'm making templates so that I can instantly use them. I don't want to be out here making it harder for myself than it needs to be. Like, I want to be able to draw lines very quickly. I want to be able to make my analysis very quickly as well. I don't want to spend hours struggling with the computer to try and find out how to annotate something, or to how to do this or how to do that. No, it has to be speed. Like, I'm a big believer of speed, guys. Like, I honestly believe that the quicker you work, yes, on the right things, like the better. So everyone that also like comes to me with proposals and this and that, like, it's always how quickly can we get it done? How quick can we be going? How quickly can we just move? Because time is running out. Just like every single day time is running out. Time is running out for you as well. And that is also, yes, why time cannot be manipulated. Price gets manipulated all the time, but time, however, can't be manipulated. And therefore you need to understand that when it comes to time purely, it's simply a matter of you just right now taking action. Don't just sit there and wait. And you know, some of you are probably like going to just chill out after this lecture, and to be fair, you should, because it's a long one already. However, in the grand scheme of things, I want you to understand that every single day you should feel like time is running out and you should just get going because people are counting on you. Now, when it comes to each one of these trading field tools, what's important to note is that what we can do is that when we draw, for example, with a line right here, what we can see is that this line right now is red. What we can do is we can go to the settings right here. It's this weird shaped tool right here. And when we press on the settings, what we can do is you can add text, for example. So we can type out, for example, liquidity right here. And when we type out liquidity, what's important to note is that what we can do is that we can change the size of the text as well. So here you can see, for example, the current size is 14, we can change it to 10, we can see whether or not it's italic or whether or not it's bold, etc. You can customize this all the way you want. You can customize the alignment, where it's placed on the chart, etc. You can all just do this based on personal preference. When you come to style, however, what I would like to see is the following. What I would like to see is that you can extend this line to the left or to the right, or you cannot extend it at all. I'm not a huge fan of extending my lines like that, because I like to extend them only from a specific price level, but we'll take a look at that later as well. And when you want to make a template, what you can do is you can press down here on template, save as, and when you type out the template name, what that does is that it saves these settings which we've just put in. So because we just made a red line with the text liquidity, whenever we go to a new line and we, for example, customize it and we make it black, yes, and we go right here to the same red template, what you can see is that the red line with the text liquidity appears. Now, you might be wondering, how is it possible that you're able to draw these trend lines so quick and so horizontal? Because I know that if you're doing it with the free hand yourself, now you're probably struggling. Well, what's important to note is that when we're drawing these trend lines, what I'm doing is I'm actually using the shift tool. And the reason why I'm using this shift tool is because when I hold shift and I draw the trend line to the right, what it does is that it actually anchors the trend line from that exact same price. So I can move to the side from that exact same price. If you do it with the free hand, well, you try to make exactly horizontal lines. Trust me, it's not possible. So use the shift tool always. This is one of those things that I learned like way down the line as well, and honestly it made my whole charting experience way better. Now, after we have used the trend line tool, what we can do is we can use the horizontal line tool. This just basically plots a horizontal line which is automatically extended all the way to the left and right. We can use the horizontal array. What this does is that it plots a line right here from a specific level, which you can then extend to the right from that specific high or low that you're annotating. I like to use that from time to time. Vertical line speaks for itself, but what it does is that it plots a vertical line at whatever moment in time you want to apply it. And then we come to the fib retracement tool. When it comes to the fib retracement tool, what this basically is that it plots specific levels within any given dealing range. So whenever I'm marking up very specific dealing range and I'm marking up very specific levels within that dealing range, what I'm actually doing is the following. Let's say that I would mark up the dealing range from this low to this high. And as you can see, I have 50% of that range outlined right here. I'll just make sure that the text is on the right so that you can actually see it. But what I would like to see is that I've 0 up here, 1 down here. And what you can see is that 50%, which is equilibrium, which is the middle point of that dealing range, is shown right here. Now, if you go to the settings right here of the fib retracement tool, you can put in whatever number you want to that you want to start paying attention to. Now, in my opinion, you can pay attention to a lot of different things, right? But at the end of the day, all that you need to know is, okay, range low, range high, equilibrium. That's all that matters. Everything else is noise. Everything else is distraction, in my opinion. You can have all the different levels in between, but why would you pay attention to all those different levels if like the main levels are these? I'm a big believer in having less drawings on your chart, because the more drawings you have, the more distractions you have as well. I want my charts to be completely clean. So when I trade myself as well, my charts are completely empty. All they annotate is maybe an old high or an old low, and that's it. That's honestly all that I like to annotate, but because I'm also sharing my analysis and such, it's of course required for me to actually annotate that what I'm referring to, because else people are like, what level are you referring to, this and that, but when I physically just plot it, it's easy to follow along with. Now, what we can see is that the next tool which we can pay attention to is the long and short position tool. This is basically the tool which you can utilize to calculate your position sizes. Right here in the middle it plots your entry. Right here on the bottom shows your target, because it's the short position tool. Stop loss up here. And the first is of course true for the long position tool. Now, if you want to open up a position on TradingView, if you're connected to your broker, what you can do is you can left click on that 2 of the risk reward, create a limit order, and you will then be able to actually fire in your limit order or your market entry as well if you'd want to. Now, when we pay attention to the final tools then, what you can see is that we have the price range right here, pretty self-explanatory, where you can measure the price range between any given point. If you think back to the price fluctuation schematic, which I shared with you earlier throughout the lecture, what you can do is basically just map the difference between a specific price and another price. When it comes to the drawing brushing tool, what you can see is that it's basically just a brushing tool which you can use to draw. Again, very self-explanatory. What we can then use is the arrow tool. Arrow tool again speaks for itself. It's simply an arrow which you can point if you want to show, okay, this is what I'm looking for, this is what happened here, etc. Now, the rectangle tool to me is very important. The reason why is because when I'm annotating any specific price range, what it means is that I can utilize the rectangle tool to actually plot that price range. So when it comes to this rectangle tool, what you can see is that I have this middle line right here, this dashed middle line. This middle line is at 50% of the price range of this box. What you can see is that when we go to the settings of the rectangle tool, you see that there's this option to enable the middle line. Turn that on if you're annotating very specific arrays, as I have outlined them throughout this lecture. These algorithmic signatures, their 50% level is very important. What you can see is that we can also adjust the background color to our liking, green, orange, blue, whatever, depends again on personal preference. And what you can see is that I have templates here as well. So I have a blue template, and what you can see is that the middle line is not on there yet. So what I'm going to do is I'm going to make sure that this gets saved and replace the blue one to this one. Now, when we pay attention to the final tool, then it's the path tool, and the path tool is in my opinion also important because the path tool gets utilized for outlining your anticipations. It gets used for basically outlining, okay, I'm looking for X, Y, Z, I'm looking for this to happen within price. When we pay attention to what it looks like, then this is basically the path tool where you can outline, okay, I'm looking for the following to occur, and when that occurs, you can then say, okay, look, price is now retracing after an expansion, so now we can expand lower, or price is now retracing lower, so now we can expand higher, etc. Now, when it comes to utilizing these tools then on an active basis, I understand that you're probably listening to me speak now and you're like, damn, what's the significance of this? Well, I told you that I would give you everything you need to make sure that you're going to take massive progress and massive steps within your trading journey. Yes, and your workflow, how you actually go about investigating the charts, is so important. So I hope that you appreciate what I'm sharing with you here now as well, even though it has nothing to do with how the markets move. This is simply making sure that your interpretation of the markets is as clean as possible. Now let us zoom into the RE chart for a moment, and what we're going to be doing is we're going to be paying attention to delivery. Now what I would like to see is that when we pay attention to this delivery, what you can see is that the market is expanding towards the downside in a very slow manner, but today the market expanded lower very quickly. Beautiful short, and I traded Nasdaq towards the downside, shorted from this imbalance right here. And the reason why I want to outline this is due to the following. I use this imbalance as an inverted value gap to go market short right here once we formed this swing high at 5 p.m. throughout the London session. What was I targeting? I was targeting sell-side liquidity resting below these lows right here. Why are these lows important? Because retail looks at those lows from the perspective of, hey, this right here is strong support, so they place their stop losses below these lows, and therefore this was my draw on liquidity heading into the day. Now, as you can see right now, my charts are very empty, and it's purely the candlesticks and the price action. I understand that that right there might be like normal to the majority of you, because this is probably how your charts look. However, in my opinion, it's very important to add specific things to the charts. So what I will do now is I'm going to be adding the indicators which I use on an active daily basis to the charts. I'm going to share with you what happens if you utilize specific tools to make sure that everything gets way cleaner for you. At the end of the day, it's about efficiency, and I'm now going to be sharing some tools which I use to make my analysis way more efficient, so that I can just come to the charts at the right moments in time, execute, walk away, spend time with my loved ones. That's the routine, and that's all that matters. And that's also the stage where I want you to get to, where you realize realize you don't need to sit behind the screens for hours in a row. Like some of you are probably in front of your screens from 9:30 a.m. to 4 p.m. That right there is not healthy, and it's also not what's going to make you the most profitable. You might think that doing more makes you more profitable, whilst in reality it's not the case. You become more profitable by focusing on the A+ setups and the setups that actually matter. Because once you take these setups and your equity starts to increase, what happens is that you will be able to risk more in those positions as well, and therefore the monetary return will also be higher. Now I'm going to be putting the indicators on, and I will be back with you shortly. Here you can see the indicators which I have added to the chart. These are the indicators which I use on an active daily basis. And why these indicators help me out is due to the following. So first of all, the indicator which I like to use is the time cycles indicator. This time cycles indicator is part of my private mentorship, Time Brand Price, and the reason why this indicator helps me out a lot is first of all because it plots vertical daily dividers, where you can see that you can have all the different days of the week right here from Monday all the way to Friday. On these smaller time frames, what this indicator does is that it plots the time cycles. The 90-minute cycles, 30-minute cycles, and the 10-minute cycles. Next to that, what it does is that it plots the opening lines. Now it's important to note that everything which I'm showing to you now, right here, can actually be manually done. So don't feel like you need these indicators. I'm simply sharing with you what I am using on an actively daily basis. So what you can see is that the time cycles indicator plots these boxes right here, and the reason why these boxes matter is because time cycles play a crucial role within my day-to-day analysis. Next to that, what you can see is that we have the opening times right here, and they are very important as well. 9:30 a.m. open, midnight open, weekly open, and the cycle openings matter to me. Important to note that these times are all in New York time, so if you haven't yet, go right here to the bottom right of your trading view to the time zone, and what I want you to do is I want you to change it to New York time, which is at the time of this recording UTC -4. Now, when we zoom out then again, what I would like to see is that another indicator which I like to use is the SMT detector. The SMT detector is a script which I created together with my team, which automatically recognizes where there are cracks and correlations between highly correlated markets. When there are cracks and correlations relative to time cycles, their highs and lows, what the SMT detector does is that it plots a diagonal line which shows to me, hey, there's SMT. There's a crack and correlation relative to this time cycle. And the reason why this matters is because this is at the forefront of every single key market reversal. You will not see a key market reversal taking place without there being time cycle SMT. Time cycle SMT is at the forefront of each reversal, and therefore I have the SMT detector on my charts always as well. And the final indicator which I like to use is the Matrix Unlocked, which is part of my private coaching program, and I won't discuss at all what that indicator does or how I use it. I'm now going to show you exactly how you can create your own trading model using Miro. Here we are on Miro, and just like TradingView, I'm not being sponsored to show this platform to you, but I'm a big fan of the platform Miro, and I believe that it's the best platform to actually create your own trading model in. What we can do on Miro is we can actually create our own whiteboards, and I'm going to show you exactly how to do so that you can lay the foundation for your own trading model. When you come to Miro.com, what's very important to note is that right here you see boards in this theme. When you press on Create New right here, I want you to press on Create Board. When you press on Create Board, what that does is that it opens up the following page where you will be able to create your own board. Once you have created your own board, the following matches will show up, where you can see all of the different templates that they have created, but we are not going to be using any of the templates because I'm going to show you exactly how you can actually create your own trading model. So here we are on Miro, and what I would like to see is that on Miro you can see on the left right here that there are a lot of different options to choose from. I understand that for those of you that are not that tech savvy, this might be quite hard to navigate, but don't worry, I'm going to walk you through it. What I want you to see is that right here we can see different shapes. Right here I'm going to be selecting the rectangle tool, and this is the tool which we're going to be working with. When we select the rectangle tool, what we can do is we can drag it out like this, and we'll be able to type inside of it. So here you can see me type out the word test. Now this word is a bit too small for me, so what I will do is I will press right here on font size. I'm going to make it a bit bigger. This is a bit too big. Let's make it 80 right here. Now what's important to note is that when creating your own trading model, you must first know exactly what you're looking for, and more importantly, when you're looking for it. So what it means is that you must first already have a very good understanding of what it is that you look for within the markets. If you're completely new to trading, I suggest you to actually just focus on learning instead of actually trying to trade your own trading model already, because you're not at that stage yet where you can create your own trading model. You should simply focus on getting more knowledge and studying more. However, if you are now at a stage where you've studied everything that there is to study with regards to time and price, and you feel like you're ready to actually begin trading in real time, I'm not telling you to trade based upon the live markets with real money. No, you always begin with demo trading, and over time what you will be able to determine for your own is whether or not you want to make the switch towards live trading or not. However, when you feel like you're at that stage, it's important that you create your own trading model. So what your trading model has to consist of is the following. First of all, what your trading model has to consist of is a method for determining, okay, this text is way too big, I'm going to make it a bit smaller, and this is what happens within these raw lectures, of course. Sometimes I might make a mistake here and there, I might have to do something twice, but I hope you don't mind. Now, what's important to note is that there must be a method for you for determining the current environment. This is what I call environment selection. So you must determine for yourself whether or not the current environment is a trading environment that you want to engage in or not. After that, what you must look for is you must determine, okay, when are you looking to engage? After you have defined when you are looking to engage, what you're then looking for is what do you need to look for to actually engage. And finally, what happens when you execute? And let's add one more, trade management. And these are the different steps that I want you to find within your own Miro board. During this training, I will not share with you what these individual boxes have to contain, and the reason being is because that right there will simply take too much time. It takes weeks, if not months, for you to learn each one of these individual steps. However, in front of you, this is simply to give you an idea of what I believe every single training approach should consist of. And this simply is the technical approach. There's way more when it comes to making sure that you manage yourself, such as journaling, such as reflections, etc. But for a technical approach, these are the requirements. You need to have a method for determining the current environment. You need to define what do you need to look for to engage. You need to define how to execute, and you need to define how to manage the trade. If you are able to define each one of these 5 steps, I promise that you're going to have a lot of clarity behind when and where you want to trade. And if you just study the upcoming months, you just focus on learning exactly each one of these individual parts, and then begin defining your trading approach, you're going to have your own trading model. And this is the foundation. And as you can see, what I've done is between each one of these individual boxes, what I did is I actually drew arrows. The reason why is because that way you can actually say, okay, step 1, step 2, step 3, step 4, step 5, etc. And that right there is very nice in my opinion. Next step, if you want to add text, what you can do is you can type out right here with the text tool. You can make the font bigger, etc. And you can simply type out hi YouTube, for example. And you can underline it, you can make it bold. And in general, I'm just a huge fan of using Miro. And if you want to, you could even add colors to each one of these individual boxes. So you could add, for example, a border style. You could adjust everything that you could ever imagine. It's pretty interesting in my opinion. I just adjusted the border. Here you can see the text, you can also highlight that, and there are just a lot of different things which you can do with this tool. Now, Miro again is a free tool to use, so you can just begin using this tool to begin defining your own trading model, and if you want to use it for your studies, you can also do so. Now, what I want to share with you is the Notion tool, which I've been using over the past few years to make the development which I've made and accomplished. This is a tool which was originally only for my private mentorship, but I've decided to also share it with you because I believe that if you use this tool, you can fast track your trading journey in a very short period of time, and you can actually make major progress. The reason being is because we actually objectify the whole trading process, from actually just opportunity logging, where you're logging where all of the different trading opportunities are, to actually making sure that you track your progress through the weeks and through the months. I will now be sharing with you the exact Notion tools which I've been utilizing over these past few years to achieve the growth which I've achieved. These Notion tools will help you structure your whole growth journey, and therefore I want to share them with you. Here you can see the Notion tools page, and as you can see, these Notion tools were originally created for my private mentorship, Time and Price. There are multiple tools inside of this Notion tool, and I'm going to walk you through them. First of all, you can see an opportunity logging tool right here, a trade logging tool, a journal tool, a goal setting tool. You can also see that you can find terminology which I use on a day-by-day basis within my lectures. You can also find a Notion tutorial, and those are the different tools which are available for free inside of these Notion tools. Now, the reason why I've decided to share this at the end of this training is because I know what of an impact these Notion tools have made within my trading journey, because I know that structuring your whole growth journey is actually the most important to achieve results in a very quick manner. Now, in order to duplicate these tools, what you can do is you can go to the bottom of this video, go to the description and press the link to the Notion tools. When you go to that link, what you can do is you can go to the top right here where it says these two pages. When you press on these two pages, what I would like you to see is that it says duplicate. When you click on duplicate, what happens is that you will be able to duplicate everything which is inside of these pages to your own Notion account. If you do not have a Notion account yet, no worries, because then you will be able to create your Notion account and use it. So when we pay attention to the overall Notion tools page, what we will do is we will actually go by each one of these different pages one by one, and we're going to be paying attention to how we can actually use them. So first of all, we're going to be paying attention to the opportunity logging tool. The opportunity logging tool serves one function, and what that function is to objectify your whole trading growth journey, where you will be able to look at every single market swing and define for yourself what variables were actually in play that set up that market run. So what you can see right here is that first of all, we log the trade number. We then pay attention to the date, we pay attention to the day, we pay attention to the session in which the opportunity presented itself. We pay attention to the market that we're logging. We pay attention to what MXM it was, whether it was a buy model or sell model. We pay attention to whether or not it was a news day. We pay attention to the exact smart money reversal time to the minute, because as your data collection continues to expand, you'll begin to see repeating signatures in the exact SMR time, the exact smart money reversal time. And that will be one of the biggest LIQUIDITY moments which you have, but that's for you to find out. After that, we will log SMT. So we will log whether or not intermarket relationship was signaling a cracking correlation. We will also log the drawn liquidity, meaning we will log what level price was actually being drawn towards. Next to that, we will log the point of interest, and that is basically the level that price originated from to actually make that price swing towards drawn liquidity possible. And we will finally also log the entry pattern that was utilized to get in sync with the market move, and we pay attention to what the Asia, London and New York morning session did in terms of did they consolidate or did they expand. These are the different variables which I want you to begin tracking every single time you come to the charts and you begin a backtesting session, or you basically just collect data of a market swing which occurred for that day. Pay attention to each one of these individual variables, and I'm 130% sure that you're going to see repeating signatures underneath each one of these different options, you can already find different options with regards to what is actually present and what it is that I'm looking for, such as time cycles, such as higher time frame arrays, such as key levels, etc. You can all find it inside of this database. So when it comes to where opportunity logging actually plays a huge part within the process which I've outlined on the Miro board, what I would like you to understand is that the opportunity logging actually comes in right here between execution, what you look for to engage, and when you are looking to engage. These are the three parts where opportunity logging plays a crucial role, because we're objectifying each one of these individual parts to actually allow you to see these opportunities before they present themselves. Now, when we pay attention to the second tool then, here you can see the trade logging tool. And the function of the trade logging tool is to do one thing, and that is to track your trading performance. This tool is simply used to track how you're performing within the market. So it's a very simple tool where you can see that we're logging the trade frequency, so we're logging what trade it is, we're logging the date, we're logging what market, we're logging the outcome of the trade, we're logging whether or not it was a market maker buy model or sell model, we monitor the risk for that individual trade, and we monitor the reward, the return for a trade, and we log the risk to reward, and we create a breakdown for this trade. And what I suggest you to do is I suggest you to actually break down the trade underneath the previous tool, the opportunity logging tool. Then you can copy the link to the opportunity logging tool, its page, and you can actually press it right here, you can paste it. When we pay attention then to the third tool, it's the journal tool. This journal tool right here is something that the majority of traders avoid. And the reason why they avoid journaling is because they are not aware of the significance of it. Let me tell you something. If you right now think that trading is purely about just coming to the charts and that's it, well, you're going to have a very hard time. And the reason why is because you need to get to know yourself. And the only way you get to know yourself is by actually journaling. So what it means is that what I want you to do moving forward is I actually want you to begin journaling a lot of different things. Such as, for example, here. What you can see is that this first journal note is called the first prop firm payout. It's a trading journal note, and the feeling that is basically attached to that journal note. Imagine if over the course of 1 year time, you're going to have a lot of these different journal notes that you write for yourself when you feel like you've either accomplished or you've experienced something that you just need to process. You just need to write it down. Just write down your thoughts and you're going to be able to learn from the experience so quickly and so rapidly. Next step, we of course log the journal date, and when you press on the side peak right here, what you can see is that you can input your journal note. Your journal is your best friend, so don't slack on journaling, guys. When it comes to the goal setting, then what I want you to see is that you can actually log all of the different goals which you might have for yourself as well. You can see that there are some physical health goals, such as hitting the gym 3 times a week, drinking at least 2 liters of water, etc. Next that you can see that there are some mental health goals, such as daily journaling, meditating, and of course personal finance, which is investing in stocks. On the vision board, you can create for yourself your own vision boards where you can attach your own images. And you can make sure that this page right here can be the page which you always reflect upon when you feel like you need to see what direction you're actually going, what the vision actually is behind why you're working this hard. It's pretty self-explanatory, and the same of course for terminology, where you can see all of the different terms which I use throughout my posts, throughout my lectures, etc. And next to that, there's a Notion tutorial on how to actually use the Notion tools. It's basically a summary of what I've outlined here in text format. Now again, to utilize the Notion tool, what you do is you go to the top right here and you press on these 2 pages where it says duplicate. Before I end the training, I want to share with you one thing which is very important. And this is a method which I've shared a few years ago in TradingView already, but I want to make sure that I share it again. And what it is actually how you access a lot of historical market data. So what TradingView allows for is that it allows for you to go back into historical market data to actually study historical price swings. This is how you're able to get hundreds, if not thousands of logs within your opportunity logging tool within the Notion tool. So don't slack on this, guys. What you can actually do when you come to TradingView is that since we are mainly focused on indices, where we're focused on Nasdaq, ES and the Dow, you need to understand that they have quarterly contracts. And what these quarterly contracts basically are, is that at the end of each quarter, the quarter, of course, moves on to the next quarter. But the old contract then disappears from TradingView. However, it doesn't really disappear. It only physically disappears because behind the scenes, you're still able to access it in a specific way. Right now, at the time of this recording, it is NQU 2025, which is the September 2025 contract that we're using to trade. If we, however, would say, okay, we want to backtest historical market data, I want to see how the months of the third quarter actually deliver, I'm going to just simply go to 2024, 2023, 2022, etc. When you type in NQU 2024, there's no charts that show up. You cannot see anything, right? But here comes the trick. The data is actually there, but all you need to do is press enter. That's it. So if I press enter now, what you will see is that all of a sudden I'm on NQU 2024, which means that I'm on the previous year's contract. And what I can then do is I can log all of the different opportunities which present itself throughout this window of time, so I can actually increase the amount of data within my opportunity logging tool. And I know that many of you are probably like, nah, why would I do that? There's no need for that, right? Well, trust me, you're holding yourself back if you don't want to do this. But I know that there will be a few people, probably a handful of watchers, that are going to be listening to me speak now, and they're going to be like, damn. I challenge each one of you individually to go out here and to literally just scroll through each individual year and see how many times that what I'm teaching for free on my public YouTube channel is repeating itself. And then at the end of your journey, where you have literally just collected hundreds, if not thousands of examples, yes, I want you to come back to me, write me an email or send me a DM and be honest with me. Is there an algorithm or not? But trust me, you will answer that question for yourself, because you will see exactly at the same times, at the same prices, the same things happening again and again. There's absolutely no way that supply and demand can be the reason why that's happening. So this is how you actually backtest historical market data on TradingView. This is the method. So we have come to the end of this training, and I understand that you might be listening to everything which you have discussed with the idea of, damn, this is a lot. Yes, it is indeed a lot. And I understand that you might be asking yourself, okay, what should you do next? Well, I want you to understand that I suggest you to go first of all to my public YouTube channel and to actually study all of the available content there is. If you subscribe to my channel and you turn on post notifications, you will always be notified when I release a new lecture. That right there is going to help you a lot already to begin seeing these algorithmic signatures again and again. However, if you feel like it's time for you to make major progress heading into the upcoming year, so that you make sure that the upcoming year you can actually begin leveling up and actually begin getting the results which you so deeply desire, then I'm happy to tell you that within the upcoming 12 weeks, if you decide to join my private coaching program, you will be guided in the best way possible to learn time and price. This does not take years to learn, but you just need to be guided in the right way. Look at, for example, Christine. Christine went on a 23 win streak after joining TMU. I released a student interview with her, which you can find on my channel as well, in which you can hear from her experience with my coaching program and how we actually made a major change on her overall trading journey. Or listen to my interview with Magnus, who decoded the algo with the help of TMU. He is a 22-year-old trader, and the progress which he made within the past 6 months is absolutely insane, and that is a true showcase of what happens when you put in the right work and are guided in the right way. Or listen to my interview with Paul, who has been trading for more than 17 years, but has made the most progress in his trading career over the past 6 months with his help of TMU. You need to understand that these are all people that are at different stages in their lives, but they're all achieving major results through our program. And that is a true showcase of what happens when the right people get enrolled into a program like ours, where the results speak for themselves. And the final interview, which I suggest you to watch, is with my student Nicole, who started trading at 44 and is now consistently profitable. That means that you are never too old to actually begin trading the right way. Even if you have been trading for a long time and you've been trying out all these different concepts and different things, but it doesn't seem like things are clicking for you, don't worry. Everything can be unlearned, and you can actually learn that what makes these markets tick, which is time and price. So if you are ready to take the next step within your trading journey, join hundreds of students of mine and learn the truth behind the markets. If you want to apply, the next step is to go to thematrixunlock.com and you will be able to apply for my private coaching program. I want to thank you for watching this training all the way to the end. It was a very long one, but I hope that you found it insightful. I shared many different gems throughout this lecture, and I hope that you were able to pick up on them. If you didn't, I highly suggest you to use the timestamps in the description to actually navigate to the parts where it didn't click for you yet. I want to wish you a lot of good luck in your studies moving forward, and I'm rooting for you. I want to wish you all the best, and I will keep you updated when new lectures get released. Be safe.